he'll be talking about the venture capital perspective. He's a researcher at CoinFund with a focus on constructing investment strategies. He has an MS in financial math from MIT, and he's a researcher on crypto asset class economics with the MIT Digital Currency Initiatives. So Ryan Yee.
Hello. Hey guys. So just as I'd just like to get a deal for the crowd. So how many people here come from the technology sector? How about the legal sector? And I guess the finance or business sector. Okay, cool. This is a good talk then. My name is Ryan. I'm a researcher at CoinFund. CoinFund is a crypto-focused investment firm. We've been operating since 2015. Have supported some of the earliest projects in the blockchain space. Basically have just seen this industry grow from what it was then to what it is now. Today we're a team of 10. We recently launched a partnership with Venrock, which is a VC based here in New York City, to basically continue to invest in this asset class. The elephant in the room is obviously the market here, but I think I want to kind of give just 4 themes to kind of think about as we close out the year for 2018 and go into 2019. And so the first theme is kind of this idea of if it's decentralized and useless, it's still useless, right? So I think one of the things early on is Ethereum kind of provided this way of creating all sorts of enforceable contracts and kind of bring different types of marketplaces. And what people kind of were optimizing for was the fact that this was a decentralized kind of technology, and kind of we're experimenting for a long time about whether or not this could actually provide use. But not only that, as an investor, whether something is valuable and whether something is investable, right? So a good example of this is like Wikipedia. Wikipedia is a very valuable resource, but it's not an investable resource, right? Every time you go to Wikipedia now, they're like begging you for money. So I think a lot of 2018 and tokens were kind of this way of kind of capitulating on this type of opportunity. And I think a lot of the reason why you see all this bloodbath in the market now is sort of the market. I mean, it's a lot of reasons, but one of the main reasons is that I think this idea of adoption and this idea of, how do we actually put a product out and understand market fit and understanding sort of the investment flows of how things get adopted over time and what that means for the assets that you're holding and whether they improve value or not. So I think 2018 was definitely a year where we basically saw that there were a lot of projects that didn't understand that, and we also saw that there were a lot of investors that didn't understand that, which is fine. I think this is just like the natural flow of markets and in general. Sort of the second theme I would like to talk about is kind of the regulatory landscape right now. So I think crypto back in 2015, it was just like this thing on the side that if you knew about, like it was this fun little thing, and it was something that most of like the regular world didn't really kind of was exposed to yet. But with the run-up of Bitcoin and all this money coming in from the VC space and the hedge fund space, and a lot of projects and technology developers leaving their jobs at like Facebook and Google to go and join the crypto industry, it's now kind of into the foray of like real life or like the real world. And so as a result, you see it interacting now with the real world, reacting to what's been happening in the crypto space. And I think this is really well documented by the actions of world governments, but specifically the US government. Right, so the SEC has basically come out and said, okay, like most of these tokens that issued ICOs or did like primary sales are probably securities offerings. So they need to comply with the relevant securities laws that you have in the U.S. And it's a really interesting kind of push and pull, because what you're trying to do is enforce geographical laws on assets that are inherently global, right? And so this is kind of like the push and pull that's probably going to exist. I mean, we started to see it kind of happen in the last quarter in 2018, but continuing into 2019, we're going to see a lot of these like frictions and a lot of the issues that come with that, right? So one of the first, like one consequence of that easily is like exchanges, right? So where can these tokens actually trade at? You know, if you take the SEC's view that these things are securities, now exchanges have to get all the necessary, you know, licensure. They have to get you know, ATS licensing, and they probably also have to get money transmitter licenses across all 50 states, which only probably less than 3 exchanges in the world currently have. The second thing is that, well, if you take the view that even if it is a security or not, I mean, it depends. I mean, you hire your lawyers to give one argument or the other, but if in general, you know, you did, you know, a primary sale in some format through an accredited investor, you know, this is something that you have to take up with the SEC, and I think most projects, you know, that are high quality tend to have good counsel, that, you know, they want this project to succeed, and so they will listen to the government and acquiesce, right? And the other thing is that, you know, this, when it was signed, it wasn't really a big issue, but the Jobs Act is basically super relevant for crypto now. And, you know, Reg D exemptions, Reg S exemptions, Reg A plus, all this stuff is like really relevant to what's happening in crypto. And just as like an example of where that friction might come through, Reg S basically has this rule that you have to prevent flow back into the US, right? If you do like a, you know, raise internationally. Well, think about that from like a crypto asset perspective. Like, do you literally have to blacklist certain Ethereum addresses from sending a token because it belongs to, you know, some person that bought it internationally? And lastly, this is like one of my doomsday scenarios, but the CFTC and the SEC, you know, recently released statements around Ether Delta, which is a decentralized exchange that was operating. And, you know, to be fair, like, yes, it was like run by one guy, he was taking fees, all this stuff, but, you know, if you want to take that logic to its extreme, what they're basically saying is that software developers could be held liable for the code that they, you know, eventually instantiate. Now, in a regular context, like, that's not like that bad, but in a blockchain context, like, it's really, really crazy. Because now if you run code, you can just instantiate it and anybody can like use your thing. Well, you know, according to the government, you may or may not be liable. And that, in my opinion, is like something that will eventually go to the Supreme Court, right? Because that's more of like a First Amendment argument. So there's all this like crazy stuff that I think over 2019 and beyond, we're going to see the push and pull of like governments and like what kind of laws that they can actually enact and how like developers and how the industry actually reacts to that. Kind of the third theme I want to talk about is just technology choices, right? So I think for the longest time we've been so accustomed to like this idea of like base layer protocols or like fat protocols as people call them, right? So Ethereum and Dfinity and Tezos and all these things are hopping up. And the idea is that, you know, this is just a protocol, you can do whatever you want with it, you know, you can leverage the tooling that you already have. You know, you can talk to different people within this space and like, you know, build together, and that's why Ethereum has kind of grown into this huge community. But at the same time, what you're also bringing in is the non-flexibility and the non-agility that comes with building on a base layer. So I think one of the things we're going to start seeing in 2019 is teams that, you know, have a very specific product market fit vision. They're going to opt to basically build their own chains. I mean, we've kind of seen this like in the previous years, like through SIA and like Steemit and you know, things like that. But I think through the open sourcing of like Polkadot Substrate and Cosmos, it's basically going to be very easy for developers now to just build, quote unquote, build their own blockchains, which is a good thing because it now gives more choices for like you know, different development teams. And I know I said 4 themes, but I guess 2 more themes. One more theme is that I think from an investment angle, you know, we see a lot of investors that, you know, either buy SAFs or buy tokens and then basically just think that they're going to go up over time. And one of the truths about decentralized networks and decentralized applications is that they're always going to need various different participants within those things. And as we shift to, you know, things like proof of stake and staking models, the idea of capital as going from passive to active is just going to become a more and more, you know, bigger part of that narrative. Right, so there's all sorts of terms out there that are being thrown, like generalized mining, active participation, mining 2.0. But what you're going to see is that a lot of, you know, investors, you know, whether they're VCs or crypto funds, are going to become more ingrained with the networks that they're supporting, And I actually like that because it does like put more skin in the game from a capital perspective. And you begin to see kind of, when you actually invest in an asset, you begin to pay attention more to like what's actually happening at the network level. And as a result, what you do is you end up becoming more data-driven, right? So, you buy an asset, you begin to see, oh, it's supposed to get staked within this network. What you can do is just call like the contract API function, just pull it from like Ethereum, like full node or API, and then you can basically track that over time and make an investment decision based on that. And the last thing I want to say is, don't think of crypto markets as completely uncorrelated with what's happening in the macro context now, right? So, recently there was a yield curve inversion, which is, kind of like a basic sign that a recession is going to be coming in like a year or two. If you look at the last quarter, the correlation of Bitcoin to the S&P 500 over a 60-day rolling period has actually been positive. Over 180 days, it's still flat, but the idea is that, what that seems to say is a lot of the capital in this space, the premise of like money managers going into crypto is the fact that this is like another asset class and it's supposed to be uncorrelated. But it seems that there is at least some like material risk when it comes to like capital outflowing out of that, especially as people want to invest in less and less riskier assets. Right, and we've been basically living in an environment now where interest rates have basically been zero for like 10 years now, and people are just chasing returns, and that's why equity prices have been so high. And I'm not surprised that crypto was like kind of part of that narrative too, and we saw that huge upshot. And as we see just a correction in crypto markets, one thing to consider is that that's not necessarily non-exposed to like the overall like macro down markets as well. So those are my 5 themes. And happy to take questions from here, and hopefully that's helpful.
Awesome, thank you. Questions?
I think in the beginning you said you do research, right? Or you started off doing research. Have you reviewed the Masari.io kind of platform where it's kind of like crowdsourcing research, and what are your thoughts about that platform?
Yeah, so full disclosure, CoinFund is an investor in Masari. Masari is kind of a response to a lot of the sinful stuff that was happening in crypto, right? There's basically no disclosures whatsoever, and Masari was kind of at least like a first attempt at trying to bring some transparency to that. And so, I think that team is definitely the right team to solve that problem. They're definitely some of like the most smart and at least the most principled people that I've met in this space. So I really like the Masari team. As for like a business model, I think that's still up for debate. We know people that work on the crypto desk for Bloomberg, and they say, Masari basically has a business model, taking into consideration that it's coming from Bloomberg. And so that's still like a material risk to that team, but I think over time, like we'll continue to track and see what happens with that. So overall, positive.
Yeah, I spend a lot of time in Asia, between Korea and Japan, and unlike the gentleman before you, his comment that this is more a millennial phenomenon than otherwise, I would beg to differ, because most of the investors out there, the average age is beyond 45 and 55. So that on that point, and a lot of them have been burned this year, and so they're looking for recourse. They're looking for ways to get their money back. So do you see, as a researcher, a demand for class action lawsuits or lawyers who can represent them across the world? I mean, where do you see that coming?
So there's definitely going to be a lot of lawsuits in 2019. And it kind of depends on how the team behind those projects were structured, whether they were structured as a team or whether they were structured as a foundation. This is not my forte. You have to talk to the GC at my company who knows about this stuff way more than I do. In general, that was kind of the issue with token sales, is that there is no recourse, right? And so that's why what you're seeing is, in 2015, everybody was investing in equity, all the value went to tokens. all those investors went back, amended their agreements, they all invested in tokens, now all the value is going back to equity for this specific reason. So, yeah, I agree, there's gonna be a lot more class action lawsuits, but it just depends on like a project by project basis. You know, I think for kind of like what people think of as a scammy ICO, it's gonna be a bit harder, because that's kind of like, the joke I like to make is like calling customer service up on a blockchain. And it's like, when you send Ether to the wrong address, you just lose it forever.
Hi, so I know Jake and I know Ross. I'm actually an attorney in this space, and to answer your question, you should look for the recent SEC actions.
Can you speak up? Can you speak up more?
There's a recent SEC settlement with Paragon, Paragon ICO, and another on the same day, where basically they came to an agreement in the fact they found that those ICOs were unregistered offerings of securities. And so the companies had to pay a $250,000 fine and had to offer the token buyers a right to rescind, meaning a right for a refund. Now, that works in the case of an ICO issuer that still has some money, right? Not all of them bought Lambos and ran off to an island. Some of them still have operating income. But there was an interesting question of what form currency the refund has to be in. If you bought it 6 months ago in Ether, and you were going to refund it or get it refunded in Ether now, it doesn't really help you. So there are, and also there are other class action lawsuits where token buyers obviously want their money back because they made a bad decision from a business perspective, and are suddenly realizing, oh, maybe the ICO is in violation of U.S. securities laws. Let me call the SEC and figure this out. And now, again, it only works if there are deep pockets of the person you're suing, but it's definitely, I mean, for my firm, that the litigation practice has grown as a result. But I want to comment on one of your earlier statements about the SEC. I mean, I work pretty closely with the SEC. One thing that companies still in this space can do, again, with their counsel, I wouldn't recommend you go in on your own, because I have a client who did that and that was a big mistake, is that the SEC is open to having a conversation before you get into trouble, right? So they welcome people to, again, with your attorney, come in if you have something very innovative, where back in the day you might request an SEC no action letter. Now you can still do that, but it could take 6 months or more to get it, and it's a rather expensive process. So in lieu of that, you can have a conversation, not just with the SEC, but the CFTC, IRS, FinCEN, et cetera. All these regulators are open to having a conversation that helps comply. Obviously, I think one of the major obstacles today is that the SEC hasn't approved the Reg A token offering yet. They're sitting on it, and Reg A, in my opinion, is probably the best exemption for those of us who are still blockchain enthusiasts or anarchists, where there is no restriction on who you can sell it to. It's not limited to private investors. But you're right, in Reg S, just in terms of even Reg D, both of them have restrictions on their resale. So how those are implemented are very difficult. And again, I suggest you speak to an attorney before you join.
So just a quick follow-up. So let's say the management team is a mix of Americans and non-Americans. So at least there's one officer or director who's an American, and they usually set it up at in some jurisdiction like in the Caymans or whatever, right? Just to make sure that they're off, they're off the radar as far as the SEC is concerned. But let's say there's at least one American who bought into the ICO, let's say. So will the SEC have jurisdiction over that kind of ICO? And if so, then do you think that that'll lead to this massive?
You should talk to her.
Okay, fine. Never mind.
I'll talk to you later.
We have more questions?
Any other questions?
Two, for one and then two.
Yeah, so recently, speaking of meetings with the SEC, Basis, one of the darlings in the stablecoin space, shut down its operation as a result of having some of these meetings with the SEC where they were almost certain that they were going to get the securities, they were going to have to be secured, or they were going to have to register. But then, I I guess that's all it took for them to kind of shut down operations. I was wondering if you could talk about sort of that space as a whole and what you guys see.
Stablecoins or
Because I think
regulation?
we have like 120 to 140 stablecoins being worked on right now. And is it going to be a situation where one winner takes all? Is it, like, what do you guys see?
So, well, I'll comment on Basis. First, I'll comment on Basis. So, Basis was not going to succeed for a lot of reasons, technology reasons actually, that people didn't really talk about as much. The regulatory reasons for sure.
But there's also something to be said about, it's great to have the first two, which is the easier one, based at fiat, or on some sort of asset, but the algorithmic one is going to be more, it was going to be more difficult anyway, right?
Yeah, I mean, it's a perpetual motion machine for its stability. So, you know, the Basis news was an interesting one. So, the way I like to think about stablecoins is basically who's issuing them and why they're issuing them. So, I would say the majority of stablecoins are created by exchanges, right? So Tether is by Bitfinex, USDC is by Circle and Gemini. Who am I missing? Gemini USD is, sorry, no. USDC is by Coinbase and Circle, and then Gemini Coin, GUSD is by Gemini, and so on and so on and so on. So the next question is, why would an exchange want to issue its own stablecoin? Well, there are a lot of tax advantages for doing so, right? So if you are trading with ETH pairs and you are also long on ETH, you're taking tax losses every time you trade into like a token from ETH. So doing stablecoins is a much easier way of doing that. Second, you have to think about exchanges today are not just exchanges, right? Like one of my theses is that like the banks of crypto, that's what exchanges will eventually become. And exchanges will just become, you know, offering all sorts of things like primary issuance, secondary trading, financial services. As we see more capital-based security models like proof of stake and things of this nature come up, we'll see exchanges play a more important role within that. Layer 2 solutions like Lightning Network and any Ethereum-based layer 2, like you probably need an MTL to be able to operate as like a layer 2 solution. So exchanges will probably do that. So the way I look at it is, you know, just consider that that space is just becoming more competitive, especially from an exchange issuance angle. And the other way to look at that is like, which stablecoin is not within that realm? And probably the easiest one to point to is DAI, right, or MakerDAO. And so, you know, when you look at MakerDAO, you can basically take the same argument, but in a decentralized context, where, you know, you have this thing called decentralized finance that's being built on Ethereum right now, which are basically like all sorts of financial service tools that you could build native to Ethereum, and they're all basically crowding around DAI, or at least the Maker system, as kind of like that stateful stablecoin. So yeah, that's my view. But I think overall, it's things like DAI and decentralized technology in general, like it takes time to scale. But I think DAI is at least one of those projects that is, where MakerDAO is at least like truly a success story, I think, or like dApps and like crypto projects. Yeah. In general, just look to who's issuing it and why they're issuing it, and you know, just go from there. And with Gemini too, there's like a regulatory. They can basically freeze the contract at their will, which makes sense because they need the green light from the regulators.
Can you share some interesting trend maybe in crypto and the blockchain technology, but in gray area like a porn industry, like the cannabis industry, technology-wise, and how investors get insights to this industry?
Okay, this is not investment advice. So, at least when it comes to porn, like it's not really porn, but there is a project called Spank Chain, which is basically a response to this like, there's these like camera girls right? And they rely on these centralized services that charge like 50%, you know, as like a fee. And basically their response is that, you know, it's also hard because like these performers also can't get bank accounts because banks discriminate against sex workers. And so SpankChain is a blockchain answer to that, and they basically take, you know, very low fees compared to anything else in that market. And they can do so because it can't necessarily be shut down because it's built, you know, on Ethereum, right? So that's an example of something like that. Now, a very real friction is, you know, if you're a fund investing in SpankChain or like the Spank token, for example, because you want exposure to that project. That's a conversation you have to have with your LPs who may have like, you know, specific clauses that sort of ban them from investing in those types of things. As for weed, I don't know. I think the weed industry is doing fine, so I don't think they need blockchain.
Okay, great. Thank you so much, Ryan.